We've had a very, very interesting past couple of years, right? And we've seen a lot of seismic disasters in the crypto industry. We've seen the likes of Celsius, FTX, Genesis. We've seen institutional-focused crypto firms as well as retail-focused crypto firms waver. And it doesn't end there. We've also seen a lot of calamities in the DeFi space, and so with all that, against that backdrop, it's interesting to see where it's all going, because one of the core arguments for DeFi is that it takes away those central intermediaries, and so with DeFi comes opportunity for growth, and we can really leverage what's happened in the past, and hopefully grow stronger as an industry. But let's start off with a round of introductions. We've got a stellar lineup of panelists right here. So let's start with yourself, Lex. A couple of minutes on yourself and your background and what you do.
Sure. Thanks so much for having me, and thank you for being here. I feel like the world is in its right place, because we're under our photos. So nobody's thrown off. Nobody's distracted by the inherent chaos in the system. I shouldn't start with an existential crisis about identity, right? It's fine. Speaking of existential crises about identity, so I'm Lex Sokolin. I was the chief economist at Consensus, which is one of the foundational Web3 firms in the space. And recently I've started a venture fund called Generative Ventures, co-founded about 3 months ago. And we focus on the intersection of Web3 and then fintech rails and AI GDP. And in particular, I'm really interested in this idea of the machine economy, and not just robot-to-robot machine economy, but the software versions of us, the Web3 native crypto wallet, digital asset owning versions of us. Where do we transact? How does that plug into our other financial infrastructure through fintech? And then when we use software tools for our productivity, for enhancing our labor with artificial intelligence, where do those digital goods go and where do they settle? So that's the thematic I'm exploring through our investing activity. Big advocate of the space, of course, and excited for this conversation.
Awesome. Tara, over to you.
Hi everyone, I'm Tara. I head up product at TwinStake. We're an institutional grade staking service, so very much in the world of institutions, so perfect for what we're talking about today. My background in the space comes from institution and enterprise the whole way through. So whether that is the compliance side of things, that's where I spent the last 4 years, basically trying to stop the bad guys interacting and stealing crypto. Then the lending and borrowing space before that, again, trying to focus on the institutional market. And my journey started out, as I think many people in crypto, escaping from the world of TradFi. So.
Awesome.
Patrick.
Hi everyone, my name is Patrick McCrory. I work at the Arbitrum Foundation. I guess Arbitrum is a layer 2 project. It's an off-chain system, and the goal is to, can you enable transactions while keeping the fees low and scale the network? And at the same time, can you build an off-chain system that retains the security of Ethereum and ultimately protects everyone in this room, so you don't have to worry about another FTX because the software protects you. And hopefully we'll get into that, software. At the foundation, I'm supposed to focus on research and education. A lot of my time has been spent on governance, working with the Arbitrum DAO. And historically, I was an academic researcher. I did my PhD in cryptocurrencies back in 2013 to 2016, focusing first on Bitcoin and then Ethereum. And I've basically done research throughout all these 10 years.
Thank you. Just a couple of things on myself. So I started my career in the traditional finance sector, unfortunately. So started off at Lehman Brothers way back in 2008, just before it went bust, and then helped with the administration.
No way,
after.
did you?
Yeah, absolutely.
I started at Lehman Brothers.
Oh, you were at Lehman as well?
2006, yeah.
Oh, okay, I didn't know that.
Yeah.
Okay, there you go. You find out a new thing about the panel every day.
Bleed green.
Yeah. And then stayed in the banking industry for quite some time. So I was at Deutsche Bank in New York in equity to prime brokerage, then moved back to London with those guys, and then more recently was at UniCredit, where I headed up UK advisory compliance and advised on their crypto activities, including a security token project. Then moved on to Celsius. I had the Lehman Brothers moment, but with Celsius.
Well
that was
done.
another great move in my career.
Where do you work now?
And right now, I'm at ID Now. So I head up crypto and fintech globally at ID Now. So we do KYC for the exchanges, the banks, the gambling sector, etc. And in addition, I'm the chairman of 1764, which opened up the UK's first private members club for crypto in the UK last year. And we're opening up a branch in Dubai in the coming months. But anyway, let's move on to the questions, shall we? So we're talking about the institutionalization of DeFi. But the question I have to open up with is, do the institutions actually need DeFi? Can they actually survive without DeFi? Can they ignore DeFi? Lex, would you like to begin with that one? What's your thoughts on that?
You're asking me dangerous questions. Did you know a fun fact? Dick Folt is actually Satoshi.
Oh, is that the case?
They found him out. Yeah, he's been cryptic. Okay, so do institutions need DeFi? I think there's a big confusion that among people who touch the space lightly, even among people who touch the space deeply, like us. I think we're all still, many of us are still confused at the edges about what things are, And I think in the question of do institutions need DeFi, it's sort of like I want to disambiguate one thing. So like, who here has an iPhone? Okay, who has Apple stock that they own, maybe through a mutual fund or directly? Do you know the difference between Apple stock and your iPhone, or do you think they are the same thing? But a lot of people are legitimately confused. They can't tell the difference between the thing and the equity representing the thing. And so when we talk about DeFi, there are different bits that we can talk about. I'll do this slightly so as to not hog the floor. So DeFi is, at first, so you can think of blockchain networks, computational blockchain networks, as super pixelated, super compressed, right? Because they have such narrow computational power, you can think of the Pong video game, right, or Super Mario Brothers, and the 16 bits, the colors restricted to some palette. It's super compressed, very, very small. And then you can imagine now, if anybody here has ever watched The Mandalorian or any Star Wars movie, you know that the whole thing is basically rendered inside of Unreal Engine. Like there's no props. It's just stuff rendered in Unreal in a giant monitor the size of this hall, right? And that's The Mandalorian. And there is a dotted line, right, from the 70s and 80s of those video games that are super pixelated to you live in a fully rendered world and you can't tell the difference. And so the blockchains of yesteryear on which DeFi was built were built in this very compressed way. And the DeFi protocols that sat on top of them are extremely elegant and very performant for the narrow constraints under which they're built. But within those narrow constraints, they are the solution for payment, banking, savings, lending, and investment, asset allocation, insurance, right? So when you take these timeless financial use cases and then you try to deploy them in very constrained and novel places, that's what you get. You get these vending machines that can generate these particular functions. So to the extent that an institution wants to transact on-chain within a native environment, and they've made that choice, those are the particular financial infrastructures that they're going to use. That's your iPhone. Your Apple stock, right, are the tokens associated with DeFi. So whether you have the Aave token or the compound token or the maker token or the stable coins that are manufactured from these machines, and then the capital markets around them, the liquidity flowing around, so the things that finance people care about, which is the liquidity, that's an asset class. And that can be traded on-chain, that can be traded in centralized exchanges, that can be traded using the lunch token cards that we had, and however you like. So again, it's important not to confuse the asset class, which again is really interesting for institutions because they can own it, trade it, have exposure to it, and so on, to confuse that with the infrastructure. And then of course we can have a long discussion about financial industry and capital markets more generally, and is there a reason to be on chain? But before going into that rabbit hole, I'm gonna stop.
It's going to be hard to stop him at one point, wasn't it?
I mean, I can jump in as well if you want. I can follow up on that point. And I got sort of two questions for the audience. The first question is, who works for a financial institution now? Like, who works in finance or fintech or any
Don't be
institution?
shy.
Institutions are wide range. That's awesome. So another question is, let's say you have some money. It could be stock or cash or whatever. And you've had to decide on a third-party custodian. That could be a bank, it could be a brokerage. Have you had to think about the custodian and the risk of putting the money in there? Have you had to think about the trust you place in that custodian and the risks involved? Raise your hand if you've had that thought. Can I trust this bank with my money? Can I trust this third party with my money? And I see some hands here. And that's a really difficult problem because right now you have to rely on humans and not software to enforce the rules. You need to rely on reputation before you're willing to give money over to this third party for this third party to do stuff with your funds. And as we saw with, unfortunately, Celsius, we saw with FTX, we even saw with Mt. Gox, and that's just the crypto industry, not even talking about the wider financial industry. These third parties are opaque, it's very difficult to judge the risks, and a lot of the time you're just taking a punt. You're like, I can sort of trust this person to do the right thing. And then you have to rely after the fact, after all the bad things happen, for the regulators to come in, the lawyers to come in, the solicitors to come in, work out what the hell happened here, and then I'll hopefully resolve the situation. So it's important to have that context, because when you think of cryptocurrencies and blockchain, I think that's a terrible framing for it, because what we're really doing is we're building, I like to call the industry trust engineering. Can you define, measure, and restrict trust? Could you allow software to enforce the rules? So I can look at this third-party protocol, like a DeFi protocol, like Uniswap. I can look at the code, I can audit it, it's very transparent, I can see exactly how it works, I can see, I can actually measure the risk I'm taking when using the software, and then I can facilitate it. I can make a good value judgment with my funds, and I don't have to trust this black box. And even if you think about like a third-party custodian, what's also nice is that you could have like a proof of, I think it's, what's the right word? Well, it's not just proof of reserves, it's like
Liability.
There's proof of reserves, proof of liabilities, and then you combine them. And okay, I guess that's not custody. Solvency, that was the word. Sorry, there's even a paper on this. Proof of solvency. You can have software that can prove to someone, here's the reserves, here's the liabilities, I can prove I'm solvent before you even put money into that. And a lot of the layer twos, like Arbitrum, Starknet, all these other layer 2 projects, you get that by default. A proof of solvency, because you look at the smart contract, you look at the assets, you can see the off-chain system, you're like, oh, it's solvent, it's working. I don't have to trust this black box anymore. Now, of course, other bugs could pop up, like software bugs and security risks, but the human element can be removed and eliminated, and now you can actually have risks that you can make real value judgments about. And to me, that's why DeFi is so important for institutions, because now they can actually measure risk and trust and make a good judgment off that, and not just rely on reputation that's very vague and difficult to measure. So for me, that's why it's critical for everyone in this room to consider it.
Gotcha. So, DeFi, the core tenets of most DeFi platforms is that they're open, they're transparent, and, that all sounds well and good, but the banks often like they like to err on the opaque. They like to operate in dark pools and executing transactions. They like to hold a lot of their information in such a way that it's very hard for the general public and even regulators in some cases to get ready real-time access to that information. So the banks as of now do not open up their books to everyone. They kind of like are very, very cagey of that information. So the question is, are the institutions a bit too intransparent? Are they too scared of transparency to engage in DeFi? And Tara, I'd like you to have a few words on that.
Yeah, definitely. So this touches on very much my old world in the crypto compliance side of things. So there is a misconception across TradFi and even into crypto that crypto is anonymous, it's all super hidden and definitely shady. Actually, some of the most tracked activity in the world. You have all sorts of crypto compliance companies who are labeling the transactions and the addresses and know the counterparties of the transactions, predominantly from an illicit crime perspective. But when you think of institutions, you don't want everyone knowing all of your holdings. You definitely don't want everyone knowing all of your transaction activity. So I think when we look at building institutional grade platforms, when we look at providing institutional grade services, there has to be this consideration about how do you provide the privacy that they can have in the TradFi world in crypto. But that's also something that crypto's been dealing with a long time. Stealth addresses are certainly not brand new, even though Vitalik started really ramping up the conversation of them. We have anonymity enhancing coins, regardless of what people may think about them. They're there to provide privacy. We've already got OTC trading in crypto, and that's a really big part of market making. So I do think for some institutions, they look at crypto and they think, actually, that's way too transparent for me. I don't want all of that activity. And that's why you have to have solutions built which look at providing permissioned activity, whether it's like a permissioned DEX, for instance. It's looking at providing coins that can have some kind of privacy functionality in. So I think it is something that's absolutely needed, but a lot of it is cleaning up the misconceptions on both sides around privacy and why it's important.
Yeah, I think for me it goes to a philosophical point about how to deal with life. I'm in like this weird zone today. So what you're describing, or I shouldn't attribute it to you because maybe you're not describing that, but one way to live is to say, okay, we do all these things. We care about the 3 days in T+3 because during those 3 days, that's when we really like squirrel in our interest payments. And if we couldn't get those interest payments in T+3, like my whole business would fall apart. So I don't want instant settlement. Fantastic logic for your T+3 business. But like taking all that stuff and then shoving it into a box that has a different shape. That's one way to go about the world. The other way to go about the world is you have a box that has a different shape, and then you figure out, okay, well, if you start with the a priori sort of givens of instant settlement, more transparency than ever, different type of attack vectors and failure modes, but nonetheless like a different a priori state, which in general I think is better than where our incumbent systems come from. What grows out of that? So to me, it's less about putting the things we have into a box that doesn't maybe behave in the way that you want, but rather you start with the new box, you start with a new platform, and then you try to figure out what can grow out of there. Like, what are the native things that benefit from pseudonymity, that benefit from being able to apply privacy in particular places, but not all places, that benefit from maximal user choice, the default that people are self-sovereign and should be afforded to hold their data, hold their identity, hold their assets, rather than starting with the presumption of the agency problem, where give me your money and trust me, right? So, I'm not as worried about like the fact that our legacy equilibrium doesn't necessarily fit perfectly. I'm much more worried about, are we growing the right things from the new place to achieve a new equilibrium?
Gotcha. So, we've seen institutions start to test out, test environments, what it would be like transacting in DeFi, but we've not seen mass adoption of DeFi by the institution. We're not seeing Goldman Sachs and JP Morgan actively trading on Uniswap against one another. What are the main frictions in the institutions getting involved in DeFi? Tara, you might have some insight.
Yeah, so you can't kind of talk about any barriers to entry without regulation as a topic. There is a big mix of regulation across the world. There's missing clarity in many places, and that's really important for institutions. Like, you want to know if the activity you're doing is okay. And in many ways, that's knowing what's not okay, so everything else is in. And there are some jurisdictions that have come out and given some guidance. There's others, like if you consider MiCA, for instance, that just cut out DeFi and said, we're not going to deal with that yet. I think that, to be honest, is quite a good approach, but it does introduce regulatory uncertainty. It means if you're an institution based in the European Union, you could potentially maybe be in trouble for doing some DeFi stuff, at least in the future, if not now, so maybe we won't risk it. So that lack of regulatory clarity is definitely a barrier to entry for some, not necessarily all. I think there's also, and this kind of, I suppose, goes into both of our worlds, but a big part of what I've done in this space has been education. It's people not understanding DeFi generally, the intricacies of it, because this is a complex space. It is different from TradFi in so many ways. There's a lot of similarities, but it is fundamentally pretty different under the hood. And so just getting, whether it's the traders comfortable, whether it's your risk department, whether it's your CEO of your institution comfortable with DeFi, that's a really big barrier to entry. And I know a lot of the institutions and enterprise companies I've spoken with, it's well, we'd like to do something in DeFi, but firstly, what can we do? And second of all, how does it work? Like if you're going to put really big volume through a DEX, for instance, you want to know the risks. You want to know potentially the counterparties, and there's some level of on-chain information that can provide a bit of clarity there, but you want to understand fundamentally how does this work? How does this fit into, or not as the case may be, existing rails and existing kind of frameworks? So I think it's, regulatory clarity or the lack thereof, that educational aspect, but also really just understanding use cases. Like if you look back at 2015, 2016, there was the blockchain, not Bitcoin era, and a lot of traditional financial companies were trying to think what could we use blockchain for? What problems could it solve? And there was a lot of kind of splatter where they just tried to throw blockchain at any problem in the world and thought it would solve whatever issue, your supply chain issue right down to the breakdown of your marriage. They just thought blockchain will solve everything.
Immutable, the marriage.
And so I think what we're hopefully moving towards now is institutions really trying to think about the use case that crypto and blockchain, DLT, choose your poison, what problem does it actually solve? And I think that's really critical for institutions, because when you're going to throw big money at a project or a POC, or you're going to stake your assets, whatever it may be, you need to be thinking what problem am I trying to solve? What risks are kind of contained or solved by this? And that real critical thinking, rather than just throwing some money towards a blockchain project, is really key. But that also goes hand in hand with the education aspect, bringing everyone in your institution along with blockchain actually being able to solve that and how.
Yeah, and maybe just to echo that a little bit. So I've definitely spoke to institutions in the past where, teams within an institution, where they wanted to interact with DeFi, but they weren't allowed to hold ETH. And you need ETH to pay for the gas fee on Ethereum or any of the layer 2s. So if you can't even hold the thing that pays the gas cost to transact, then you can't even interact with DeFi. It's the one big bottleneck. But I think it's also important to step back a little bit and just think of timelines of why are institutions still hesitant to interact with DeFi. Bitcoin today is about 14 years old, 13 years old. Ethereum is about 8 years old now. It was 2015 July. And DeFi, you could argue the start point for this means DeFi really started kicking off in 2018 when Hayden launched Uniswap V1 after getting a 50K grant from the Ethereum Foundation. And that's basically 5 years old at this point. But really it's 3 years old by the time that matured, and you got V2, V3, you had Aave, you had Compound, and then you had DeFi Summer, then you had the basic past 2 years. So DeFi is only 5 years old, let's say, but really only 3 years old in terms of real usage by people. And it's still really early for institutions to get involved. If anything, I consider our industry right now on a battlefield. We're trying to build resilient systems that don't rely on human trust, that can last the test of time. And every project out there, including the layer 2s, we have our own opinion on how this software could run. And we have these different configurations, different software stacks, and we're all competing in the market to build the most resilient system. And so institutions can wait another year or two if they want. And by that stage, the software will hopefully be ready for them to dip their toes in a bit more. So I'm not really worried. Timeline-wise, it's still so early for everyone. I know that's a bit of a meme now, but it really is. It's 3 years. How can you expect a huge institution to move that fast? I don't want to call them boomers, but they're all a bit slow, aren't they? It means it's moving because it's such a big org and risk appetites. So yeah, I think it'll come soon.
So we've touched on risk there. So the big banks, financial institutions love quantifying risk, and part of that is down to capital requirements. Banks need to measure operational risk, credit risk, and a whole host of risks, and at the end of that, their capital needs to be adjusted. But DeFi has some risks beyond. It might mitigate some of those risks, but it also has some new risks. So how would an institution navigate those emerging risks from DeFi? Lex, can you give us a bit of a feeling as to what are the sort of risks that might actually be mitigated from DeFi, and what are the new risks that might be emerging from DeFi?
Yeah, I'm very good at feelings today, so I'm happy to share. So before answering that question, I'll say what I want, which is there's an obsession in the discussion about regulation, friction, user interface problems, hacking, the cost side of the equation. As if we just removed the cost side of the equation, that would mean everybody comes in. Well, I don't think that's right. I don't think that, first cost, then benefit. It's the other way around. If there's sufficient benefit, if there's enough here in DeFi and Web3, if you can make $1 million by clicking 20 buttons every day, you will click those buttons and then you will pay the IRS and the SEC fine, 5 years later. That's literally how it's shown in human behavior. So the benefit has to be immense, and then people will be like, the costs are expensive, how do I address them? Nothing will happen if you're like, we've smoothed everything out, but you can get a 0.5, you can get 5 basis points of margin interest on some protocol that has 100 million in TVL. Like, there's no benefit at all. So the number one thing the space has to do is the carrot. It's the value proposition, the benefit, and then people will go through hellfire to get the thing that is actually beneficial. Now, that doesn't mean we shouldn't work at the risks and the costs, but it's not the driver. It's what we're talking about because we haven't generated sufficient benefit for anyone to care, and we should really own that and sit with that, because if we did, the entire country of the Philippines was clicking a button for 6 months because we were paying them 10 times their daily wage in a token video game, right? Regulation, friction, hacking, super irrelevant, uninteresting, and besides the point, because that's not what drives human behavior. So that's my aside. To your point of the new risks, so you're removing sort of the credit risk that traditional finance interactions have. You don't have the agency sort of problem where somebody wants to take your stuff because you gave it to them and they just promised to be nice. But you are introducing software failure risks, right? So you can have the software fail because of error. You can have software fail in all sorts of exceptional black swan cases where the human mind has not yet understood what is possible, what can happen. And you can have these machines fail for pretty straightforward market manipulation reasons. There's a fantastic example of Twitter cartoon villain, is it Eisenberg? Dr. Eisenberg?
Abraham Eisenberg.
Say again?
Abraham Eisenberg?
Yes, Abraham Eisenberg, who believed himself to be a righteous advocate of the free market by attacking a DEX and manipulating the underlying prices in such a way that he got $100 million. He tweeted about the whole thing because he thought he was super cool. Until eventually the feds got him and booked him in jail for market manipulation. But that's not like a software problem. That's like, dude shouldn't market manipulate, in public. So I think there's the novel risk.
Glad he got caught, by the way. Just highlighting that.
Say again?
I'm glad he got caught.
Yeah. No, it's fantastic that he got caught because people shouldn't think that just because they're market manipulating code, they're not market manipulating. It's wrong. You are inadvertently stealing. So I think there are these novel risks in terms of understanding the software, understanding things around audits and making sure that the software is battle tested. You want some risk capital in that software. You want it to be hacked and people to lose some money so that by the time you're using it, all the exceptions have been proven. But you do get a lot back, and moving away from custody, I think, is one of the most important benefits. But Curious what others think.
I mean, I was just going to say, like, it's a bit of a meme out there, but that's why Solidity is so sticky. Because Solidity has lost so much money, over the years on building smart contracts on Ethereum that there's a good understanding now of the bug. I mean, there's still bugs out there, but there's a strong understanding versus introducing a whole new programming language and, execution environment where it's like, well, we've already lost so much money here. We've learned the lessons. Like Solana had this issue. They had this bug in their bridge where they didn't check a digital signature, and that led to the bridge being hacked. Well, that's just because it's a whole new environment. So if anything, we get stuck with these languages because we lost so much money on it already. And it's a bit annoying. It makes it hard to evolve the language because you're stuck with this old language. I just wanted to mention that as a bit of a side point. This is interesting.
Gotcha. So, I mean, we seem to be all like waiting for this pivotal moment where the institutions get in. But, if they did get in, what might the impact actually be? Tara, would you like to take that one?
Yeah, so I think it depends kind of how and where they get in. So if you consider the staking industry where I'm kind of based and working in, we do see a lot of institutional interest already. You've got, billions and billions of dollars being staked by institutions. So having more institutions in and more institutions staking, great from a decentralization perspective to have more people staking in the right ways. But it does also potentially start spreading rewards slightly thinner. So, you get the benefits of them coming in and dipping their toes in the water, maybe getting more comfortable with other elements of DeFi as well. Staking is kind of your low risk entry point into the DeFi world. Maybe we'll start getting loads of institutions that want to use DEXs. Okay, well, that's definitely going to bring a lot more kind of regulatory scrutiny. Is that going to bring more on-chain surveillance into the world of DEXs? Are they going to move off into a kind of permission DEX space for them? I think it really depends where and how the institutions are getting in. Definitely brings more money. That's a big one. That's probably more from an investment perspective that we'll see with the institutions coming in. It will also likely drive a lot of maturity and professionalism in the space, just because institutions expect more. Like when you're dealing with an enterprise or an institution, they expect your, even down to your APIs to be more robust, more clear, have a higher number of calls that they can accept. So they bring with them very long RFPs that require, your security standards to be stronger. They have a zero tolerance when you say, oh, we just haven't got around to auditing that yet. Like, no, okay, get it audited. And that's no silver bullet. We all know that there's a lot of services in crypto which have been audited and then hacked. There's, memes and parties for that. But it does provide much more formalization and professionalization. So I think the institutions coming in will raise a lot of that up. It's by no means some kind of silver bullet for the industry. There will be crypto before the institutions, there will be crypto after the institutions, which is largely carved out. But I think for anyone operating in the institutional space in crypto, it's going to push all the standards up. It's going to mean that, when we say we're non-custodial, we really focus on reg and compliance, retail largely don't really mind about that as much, or SMEs don't really mind, but the institutions come in and say, yes, that is what I want, which is great. Like, yes, that's why we're building it for you. So I think there's a lot of benefits for the institutional players in the space right now once we get more in. But I do also agree with what you were saying before, that there is a bit of time to wait for that because we still are super early. So it's about kind of laying those foundations, be ready for them, and then when they come in, being ready for the requirements that they'll very naturally bring.
Yeah, maybe just to pick up there, because you mentioned like the permission DeFi world. Was it sort of like, it's a side path in the cryptocurrency industry, there's a side path of permission DeFi and blockchains that's been going on since like 2016. I think it really gets to Lex's point, if we really want institutions to use the public rails that we're building today as a technology stack in a permissionless setting where anyone can participate, the carrot needs to be there, because they may end up behind this walled garden of a permissioned ecosystem, which may be fine for the institutions, but I don't see that. For me, that's not the valuable part. The valuable part is building this credibly neutral platform that protects all of its users, not just certain actors. So we need the carrot to be there in order for them to come, to really use our rails.
Yeah, permission DeFi doesn't all the way work, because then you just have Citadel fighting Renaissance, and that's not who they want to trade against. They want to trade against us so they can beat us and take our money. So you need a market that has both retail and institutional in it, and any trader will tell you that. The other thing I think that, is it okay to me?
Of course, we've got a little bit of time.
All
Yep.
Right. I like that I'm asking you for permission. It's
It's a permission statement, isn't
feeling
it?
sheepish, yeah. I'm feeling institutional. Am I compliant?
Have I KYC'd you yet?
I hope not. Okay, so the first point is that I think a lot of people miss, not because it's mysterious, but because it's so boring, is that everything has to be integrated into the tech stack that our orthodox financial system uses. So portfolio management, performance reporting, it has to be in Bloomberg, it has to be, this data has to be in Morningstar, right? Like all of the stuff has to be in a place where it already is. The banks literally will just not, if it's not part of the existing asset class infrastructure, it's not going to work. So integration into all of the stuff upstream has to happen, and that's what I think companies like Fireblocks and the ones that are starting from the capital markets tech stack and solving back into crypto kind of got right. But it's hard to do, and it's not that exciting. And the second thing is at the end of the journey, and I think the biggest carrot, really, at the end of the journey, let's say Ethereum is worth $10 trillion, right? That's the market cap. And let's say in that situation, there's not a lot of capital gain and capital loss, because it's very confusing interacting with some of these assets because their fixed income characteristics are not noticeable in the context of the high-tech speculation that goes around them. So it has to 10x or 20x from here in order to be so large as to not experience kind of crazy volatility. And so in that situation, once you start looking at the monetary policy of Ethereum, it becomes, profoundly compelling. Really, really compelling as a monetary system. And I apologize to all the Bitcoiners, because that's profoundly interesting as well in terms of holding a thing for a long time. Is that an incorrect description?
Cynical, isn't he?
Yeah. Come on, I own Bitcoin. Okay, so the Ethereum monetary system is really elegant and wonderful. So you have programmatic inflation. Right, so tiny bits of inflation, and then if people are using Ethereum, and if there's an economy, if there's a GDP, and the money rotates, then that inflation starts to go down as the things get burnt as part of the gas fees. And so you're basically kind of floating around the money supply depending on how much the economy is used. So it's in some sense self-correcting. And then going to staking, some portion of the holders of Ethereum want to hold it for a long time. Some people want to spend it like money. And so the people who want to hold it for a long time get to participate in the tiny inflation, but there's not that many people that want to stake. So right now it's 20%, maybe it'll go to 50%. And only those people get that tiny bit of inflation. So all of a sudden, those people can actually be getting 5% interest rates denominated in ETH, while the overall inflation of the thing is 2%, right, or 1.5%, or even so it becomes a really interesting financial asset, and it really is a risk-free rate. And the best part about it, for me, is that it is a real inflation rate. It's not a nominal one. So, in the U.S., the money supply, grows. So there's a big difference between real and nominal rates. For ETH, that's the real rate. And so in the U.S., if interest rates are 5% and in the bank you get 5%, what do you get? You get no percent. Nothing's happened. You've played Monopoly and you're in the same place where you were before. Whereas in the ETH monetary system, the interest that you get is real interest. So the extra ETH you get is actually going to grow your position. And so I think as a NASA class, it's an incredible experiment if we end up with a multi-trillion-dollar fixed income instrument that is powering a digital GDP. I think that's really compelling. And in that institutional case, you're going to have $1 trillion of that as your assets and so on. So that's I think for me the bull case for what the financial aspect can do.
Unfortunately, we're pretty much all out of time. But anyway, we'll all be around throughout the conference, so you can grab us and ask whatever questions you might want to pose. But in any case, I hope you found this discussion insightful, and let's give a round of applause for the panel.